first of all, on the news since the last show, I think the biggest news by far is the 200 metric ton purchase of gold by the Central Bank of India from the IMF. Now, if you remember months ago when it was first mentioned that the IMF was going to be selling all this gold, I said not to worry. There were people who were saying that this is negative for gold, that this is a big supply, the selling is going to suppress the market. I said not a chance. I said there were plenty of foreign central banks that would love to get their hands on IMF gold, and the IMF would have no trouble finding large buyers from foreign central banks, and that's exactly what happened. And I think the IMF is stupid for selling this gold. They should hold on to it. And the fact that they're selling it is a great opportunity for India, who bought it. I'm sure China is feeling the pressure that they need to buy more. India, even with this purchase, their reserves are only 7% in gold. So they're 93% in paper, mainly dollars, only 7% in real money. In China, even though China has more gold reserves than India, their reserves are only 1.5% gold. They are loaded up with paper. They need to buy gold in a big, big way over there in China. I don't know how they let these 200 metric tons slip beneath their fingers into India. If I was China, I would have made a bid for the of IMF gold, and I would have paid a premium to get it. But we'll see which foreign central bank, whether it's China, whether it's Brazil, whether it's Russia. These emerging market economies, these developed, they are so underweighted in gold right now, and they are flush with rapidly depreciating paper dollars. And we know they're going to keep depreciating. Ben Bernanke came out today and announced that, guess what? Interest rates are staying at zero indefinitely. That's basically the call from the Fed. Even though they think the economy is improving, they still think that it's so weak that interest rates have to be zero in order for it to not collapse, which is, an amazing statement in and of itself. The dollar was down once again, and of course the price of gold on the news that India bought was up, I think, $25 an ounce that day, $30 or so. It was up again today. It's at new record highs. We're almost at $1,100 an ounce on the price of gold. And if you look at the Dow priced in gold, the Dow continues to fall. The Dow is now just worth a little more than 9 ounces of gold. The Dow was worth 10 ounces of gold just a few weeks ago. So that's a 10% drop in the real value of the U.S. stock market. Even though you don't see it in a nominal sense, I think we're headed back down to 8-1 relatively soon. And by next year, I expect the Dow to be worth just 5 ounces of gold. I don't know exactly where the two are going to be. It could be Dow 10,000, gold 2,000, right? Or it could be Dow 8,000, and then gold would only have to go to 1,600 or not 8,000 or whatever times, not 1,600, but you do the math. But, it's going to happen. And, I would just continue to buy the precious metals, keep buying gold, keep buying silver. I mean, silver is trading well. Silver hasn't even made a new high yet. But I think the charts look extremely bullish for both gold and silver. I commented on my video blog, and if you're not watching that, I do these video blogs. Sometimes I do them daily right now on my website on YouTube. But I commented on Friday because it seemed to me that gold was very strong that day. Even though the Dow was down about 250 points intraday, gold recouped a $10 loss and closed flat on the day. That, to me, that day showed some underlying resilience in the price of gold. And boy, ever since that day, we've had Monday, Tuesday, Wednesday. I think we're up $10 on Monday, $30, another $5. So we've had 3 solid up days in a row ever since that recovery. But even though gold is at new highs, silver has still not taken out even its highs from a few weeks ago. And the gold and silver stocks, if you look at the HUI index, the HUI, that's well off its highs of this move, let alone the highs from 2008. I mean, back in 2008, in March of 2008, when gold barely touched 1,000 and then pulled back, that HUI index got to 520. Now we're almost 10% above 1,000, and the HUI's 100 points lower. So I think gold stocks still offer a lot of value. Again, if you're interested in these types of stocks, I got a new research report that's coming out soon about my 5 favorite gold stocks to buy. But if you're interested in finding out which stocks I like, finding out they're suitable for you, make sure to contact your broker at Euro Pacific Capital. Give them a call, 800-727-7922, 800-727-7922, to talk about the gold stocks I like or any other foreign stocks I like if you want to get in on the gold move. Also, the physical bullion, I still strongly recommend that people have physical gold. We've been selling gold through the Perth Mint. I think it's a great way to have gold and silver and have it offshore. Again, call us at 800-993-8350, 800-993-8350 to learn about the Perth Mint and holding gold through their certificate program in Australia. Also, what else? I happen to speak today at a commodity conference on the New York Stock Exchange, or at the New York Stock Exchange, and then I actually did a hit on Fox Business, live from the floor. But I spoke. Before I spoke, Muriel Rubini spoke, and I got to hear the tail end of his presentation. And he wrote an op-ed in the Wall Street Journal about the mother of all carry trades in the U.S. dollar, and a number of people emailed me asking me to comment on what he had to say. And I disagree with much of what Rubini is saying. Basically, his position is that there's a giant worldwide global bubble funded by the dollar carry trade, that everybody is borrowing in dollars and leveraging up and buying what he says are risky assets. And he says that since the dollar can't drop forever, at some point we're going to have a sharp rise in the dollar, and then everybody's going to have to cover these trades, and the global markets are going to come crashing down. Well, I think the event that Muriel Rubini is describing already happened in 2008. I do not think you're going to see that liquidity-driven flight to the dollar, global synchronized sell-off happen twice in a row. I think the odds of that are slim. And I think Rubini is making several mistakes in his analysis. First of all, he's assuming that let me backtrack. First of all, Rubini assumes that the dollar is the safe asset, and that all the other things that people are buying, like gold, like silver, like commodities, like stocks and real businesses, that those are the risky assets. And he thinks people are taking a lot of risk in the investments that they're making. See, I think he's got it backwards. I think they're fleeing risk. I think people are buying gold because they're afraid of the dollar. I think people are buying commodities because they're afraid of the dollar. They're trying to escape risk because they understand where the risk is. The risk is in holding a currency that is being printed into oblivion. That's the risk. So the fact that people don't want dollars and want other assets isn't a sign of risk-taking. It's a sign of risk aversion. That's number one. Number two, he's assuming that all the people buying gold or all the people buying stocks are leveraged, that they're all doing it with borrowed money. Well, that's nonsense. The vast majority are not. Look, I've got 10 to 15,000 clients at Euro Pacific Capital. We're buying foreign stocks. We're buying gold. We're not doing it with borrowed money. We're not on leverage. We're not going to have a giant margin call if for some reason the dollar were to go up. And I think that's the case in most parts of the world. There are real buyers here. This is not speculative money. This is not just hedge funds that are leveraged up. There is real money coming in. Look, when the Bank of India just bought 200 metric tons of gold, they didn't do it on margin. This is a real purchase with real money, and this is going on all around the world. That's another thing that he misses. Number three, he's talking about this huge rise we've had in global stock prices, which he looks at as a bubble. But he's not looking at the complete context of where these stock prices are rising from. Many of these stocks in Asia were down 70, 80, 90% in a 6-month period in 2008. The fact that these stocks have moved up so dramatically in the last year, in most cases, they haven't even returned to the prices where they were a year ago when they went down by amounts that was completely unwarranted. You had a fire sale on these assets. There was this credit crunch. They were throwing them out the window. They never should have got that cheap. The fact that they've now risen so much doesn't mean that now we have a bubble, right? If a stock goes from $10 a share to $1, and then it goes back to 5 or 6 to say, well, it's a bubble because it's gone up 5 or 6-fold, you're missing the fact that it dropped 90% before it did that for no real reason. Right? So in most cases, these stocks are simply recovering ground they never should have lost in the first place. Because I think the people that were selling these stocks didn't understand the fundamentals, and in many cases, the sales had nothing to do with the fundamentals. They had to do with liquidity. They had to do with the need for cash when nobody had any. So most of the stocks that I look at are not trading at bubble valuations, period.